Imagine waking up one morning to check your investment portfolio and seeing your net worth cut in half. Overnight, stocks you thought were guaranteed winners are plummeting, and the headlines scream about the largest market crash in decades. You're not alone. Throughout history, bubbles have formed, inflated, and then burst, leaving millions of investors reeling. Yet, investment. Despite decades of warnings from economists, financial advisors, and market veterans, people still get trapped in the excitement, chasing quick profits while ignoring the underlying risks. Right now, we might be standing at the peak of the biggest stock market bubble ever. Tech stocks that once seemed unstoppable are now trading at valuations that defy logic. Investors are pouring money into speculative assets without understanding the true value or lack thereof. It's the classic trap FOMO, fear of missing out, investment, pushing people to make emotional decisions instead of rational ones. Bubbles are seductive because they promise wealth with speed. You hear stories of early investors making 10 times their money in a year investment, and it feels like everyone around you is getting rich while you're missing out. That emotional pull can be irresistible. But history teaches us that what goes up too fast often comes crashing down. And the aftermath isn't just financial, it's emotional and psychological. In this speech, we're going to break down exactly how to recognize when a bubble is forming, why it's so dangerous, and the steps you can take to protect yourself from getting trapped. We'll explore the psychology behind market bubbles, the key warning signs in today's stock market, and proven strategies that can safeguard your wealth. By the end of this discussion, you'll understand that the smartest investors don't chase hype. They prepare, they analyze, and they act strategically. Whether you're a seasoned investor or just starting out, understanding bubbles isn't optional. It's essential. Because when the market finally corrects, it won't discriminate. Investment. It doesn't care whether you're new or experienced. Anyone riding an overvalued asset can face massive losses. So let's dive deep into the 4 critical points that will help you spot, survive, and potentially profit from the biggest stock market bubble in history without falling victim to it yourself. A market bubble doesn't happen overnight. It's the result of a perfect storm of factors that push asset prices far beyond their true value. At the heart of every bubble is speculation. Investors start buying not because an asset is fundamentally sound investment, but because they believe someone else will pay more for it later. This is often called the greater fool theory, where people invest in overvalued assets hoping to sell to someone even more optimistic. The danger is that this cycle feeds on itself, inflating prices with no real connection to the underlying economic reality. Easy access to credit is another major factor. When borrowing is cheap and plentiful, people can invest with money they don't actually have, amplifying the upward pressure on asset prices. For example, during the housing bubble of 2008, mezz lenders offered mortgages to people who couldn't realistically repay them, which fueled a housing price surge that was completely unsustainable. Similarly, in today's markets, low interest rates and easy financing can create artificial demand, making assets appear more valuable than they truly are. The psychology of investors is just as important as the economics. Fear of missing out drives people to make decisions based on emotions rather than logic. When they see prices climbing rapidly, it's easy to convince themselves that this time is different, that the growth is justified, and that the risk is minimal. Herd mentality takes over, and soon rational analysis is ignored. Social proof, media hype, and constant success stories amplify the effect. Everyone wants to ride the wave, investment, and as more people jump in, the bubble inflates even faster. History is full of examples that highlight the same pattern repeating over and over. The Dutch tulip mania in the 1600s, the dot-com bubble in the late 1990s, and the US housing bubble of the mid-2000s all followed a similar trajectory, a rapid rise in prices driven by speculation, widespread excitement, and easy credit, followed by an inevitable collapse when reality caught up. Understanding these historical patterns is crucial because they reveal that no bubble is unique. The underlying human behavior, greed, fear, and herd mentality remains constant even as markets and technologies change. By recognizing how bubbles form, investors can approach markets with caution. Awareness is the first line of defense. Understanding that rapid, unexplained price increases are often unsustainable helps prevent impulsive decisions. Instead of chasing short-term gains, the focus should remain on evaluating the intrinsic value of assets, staying disciplined, and preparing for potential corrections. Being mindful of these dynamics allows investors to avoid being swept away by hype and make decisions grounded in long-term strategy rather than temporary excitement. Right now, there are clear warning signs that the market is experiencing extreme overvaluation, and ignoring them can be dangerous. One of the first signals is the sheer level of asset prices compared to their underlying fundamentals. For example, when price to earnings ratios for major companies reach levels far above historical averages, investment. It indicates that investors are paying more for earnings than is reasonable. This often happens in sectors that attract intense speculation, like technology, artificial intelligence, or cryptocurrencies. While these areas can have tremendous growth potential when valuations detach from realistic earnings projections, it's a classic sign of a bubble. Another warning sign is market behavior driven by hype rather than logic. When new investors flood into the market, often fueled by social media, news outlets, or celebrity endorsements, it creates an artificial demand that inflates prices. Media coverage emphasizing the next big thing or rapid gains encourages people to invest out of fear of missing out rather than sound analysis. This herd behavior is a major red flag because bubbles are as much psychological as they are financial. When emotion replaces rational decision making, the market becomes fragile. Investment. High trading volumes and speculative frenzy are also indicators. Sudden spikes in buying or selling activity, particularly in stocks with little historical stability, suggest that people are acting impulsively. Day trading, meme stocks, and viral investment trends often accompany bubbles because they thrive on hype rather than fundamentals. These patterns are not just anomalies. They're early signals that the market is being driven by excitement, not economic reality. Looking at macroeconomic factors can also reveal danger zones. Debt levels, easy credit, and excessive leverage in both institutional and retail investing can push asset prices higher than they should be. Comparing current market ratios to historical averages, such as market capitalization relative to GDP, can highlight unsustainable growth. When these metrics reach extreme levels, it's a clear warning that the market is overextended. Recognizing these signs doesn't mean avoiding the market entirely, but it does call for caution and strategic thinking. Being aware of overvaluation, speculative behavior, and excessive leverage allows investors to protect themselves before a correction occurs. Investment's about taking a step back, analyzing the facts, and understanding that when the hype fades, reality will assert itself. By paying attention to these warning signs, investors can position themselves to survive volatility, avoid panic losses, and even take advantage of opportunities when the market inevitably corrects itself. Awareness and vigilance are key to navigating the biggest stock market bubble safely. One of the most overlooked aspects of a market bubble is the role of investor psychology. Greed and fear are powerful forces that can push markets far beyond reasonable valuations. When prices are rising rapidly, greed takes hold. Investors see others making huge gains and start believing that they, too, can get rich quickly. This emotional response often overrides logic, causing people to ignore fundamental analysis and chase trends. They convince themselves that the growth is justified, telling stories like this time it's different, even when there's little evidence to support it. Herd mentality amplifies this effect. Humans are social creatures, and we tend to follow what others are doing, especially in situations where uncertainty is high. When a large number of investors are buying into an overvalued asset, others feel compelled to join in, fearing they will miss out on potential profits. This collective behavior fuels the bubble, pushing prices higher simply because everyone believes they will continue to rise. The result is a market driven less by logic and more by emotion. Investment, which makes it increasingly fragile. Fear also plays a critical role, though it often appears after the bubble begins to burst. When asset prices start to decline, panic sets in. Investors who previously bought in out of greed now sell out of fear, creating a cascade effect. This is why losses during a market correction can be so severe. It's not just the drop in value, but the mass psychological reaction that magnifies the impact. Understanding this dynamic is essential because most market crashes are accelerated by emotional responses rather than underlying economic factors alone. Self-awareness is the first line of defense against these psychological traps. Investors need to recognize their own biases and emotional tendencies. Impulsive decision-making, overconfidence, and fear of missing out can all lead to poor choices during a bubble. Developing a disciplined investment plan, sticking to it, and avoiding emotional reactions to short-term market movements can protect both wealth and peace of mind. Education and perspective are equally important. Studying past bubbles and crashes helps investors understand that human behavior is remarkably consistent over time. Patterns of greed, fear, and herd mentality repeat regardless of the era or the market. investment. By recognizing these patterns in themselves and in the broader market, investors can make informed, rational decisions. In essence, mastering the psychology of investing isn't just about avoiding losses. It's about being prepared to act strategically, staying calm during volatility, investment, and positioning oneself to benefit when the market inevitably corrects itself. Awareness and discipline are the keys to surviving and even thriving investment in a bubble-driven market. Protecting yourself during a market bubble requires more than just recognizing the signs. It demands a clear strategy and disciplined execution. One of the most effective ways to reduce risk is through diversification. Spreading investments across different asset classes, industries, and geographic regions ensures that even if one sector collapses, your overall portfolio remains relatively stable. Relying too heavily on a single hot stock or sector during a bubble can be catastrophic, but a diversified approach mitigates exposure to sudden downturns. Risk management goes hand in hand with diversification. Setting limits on how much of your portfolio is invested in highly speculative assets, using stop-loss orders, or allocating a portion of your capital to safer, income-generating investments can prevent massive losses. Keeping some liquidity, such as cash or cash-equivalent assets, provides flexibility to act when market corrections occur. Investment. Cash allows you to buy quality assets at discounted prices after a bubble bursts, turning potential market chaos into opportunity. Long-term investing in undervalued or fundamentally strong assets is another key strategy. While the market may be dominated by hype during a bubble, maintaining a focus on companies with solid earnings, sustainable growth, and competitive advantages can protect your wealth. These investments are less likely to be impacted by speculative swings, and when the bubble bursts, they often outperform the highly overvalued, hyped assets that collapse most dramatically. But hedging strategies can also play a role for more sophisticated investors. Options, inverse ETFs, or other financial instruments can provide protection against downside risk. While these tools require careful understanding and management, they offer an additional layer of security in volatile markets. Finally, education and continuous analysis are indispensable. Monitoring market trends, understanding valuations, and questioning the hype helps investors make informed decisions rather than reacting emotionally. Being aware of historical bubble patterns, understanding financial statements, investment, and staying disciplined with a long-term plan are the foundations of successful investing. By combining diversification, risk management, long-term value focus, and continuous education, investors can navigate a bubble without being swept away by speculation. The market is cyclical and corrections are inevitable, but those who prepare strategically not only survive, they can even capitalize on opportunities when the hype fades and reality sets in. The goal is not to predict the exact moment of a crash, but to position yourself in a way that protects your capital, reduces stress, and allows you to act decisively when others are reacting emotionally. Smart preparation is the ultimate defense against the dangers of the biggest stock market bubble.